Hello guys, welcome back to the Lumley trading video. In this one we are going to be doing some in-depth stock analysis over on AMC Entertainment because it is down over 20% on the day. Firstly, why is it down? They have kind of settled with shareholders and are now able to convert their preferred shares over to common shares. Now why is this a big impact on the stock? Because preferred shares offer kind of stable dividends and are also more of a priority over common shares. So if a company has to do this, it's usually just a weak sign because, again, now they don't have so-called guaranteed dividends. It's kind of more optional dividends when it goes to a common share. So yeah, now they don't have that set kind of dividend they have to pay each quarter. But also, again, it's just weakness. If you're going from preferred shares to common, it's just showing that they may not be able to pay kind of future dividends to their preferred shareholders. So again, not a great sign to be seeing, and this is the main reason I guess we're seeing AMC just hit its 52-week low of $3.64. So what are we looking at from here? And again, a lot of people are kind of being left back holding this. Even my good friend Hamza Khalid put in near enough his life savings into this, and since then has decreased by nearly or over 90% since he bought them. Now, what are going to be these key levels? Because obviously it's kind of a stock you should be out of. From a technical and fundamental standpoint, it is just not a stock to be holding. Now, if we were holding it now, would we be cutting out now? Probably not, because again, we are near those lows. With this kind of stock, we do expect some sort of move to the upside, whether that's just a small pump or a temporary squeeze. Considering we've seen it so many times in the past, we'll probably see it again. So it would be one of those things. I wouldn't be cutting losses, under that $4 mark. But if we push up to maybe $5 or above, definitely a stock. That's where I'll just be cutting losses, take whatever loss you have, and then just be looking to invest elsewhere. But what are key levels from a standard deviation perspective to be paying attention to? So if we go to the downside, we do have supports, statistical means at 280 to around 215. Now, these tend to be targets, not so much supports, in the sense we don't look to buy this level in anticipation of the bounce, but instead, if we were holding the stock short, this is usually going to be our target. And considering, again, we've had that bad fundamental catalyst, we are most likely going to continue down. So 280 is going to be that target in time, but obviously still requires quite a big sell-off from where we are now. Considering 390 to around 280 is around another 27% sell-off from where we are now. That would be our target. Really, if we break below that 215, we don't have any deviational levels, so it will just be looking at those key psychological levels. So $2, $1.50, $1, and so on. Now onto the upside again, $5 is probably where I'd be cutting out. And the reason for that is big psychological level in general, but also, again, if you're looking at this stock from a technical standpoint, it has been a noticeable support and resistance. And considering, again, there's another fundamental issue for it to push to the downside, this is most likely going to stay as its kind of top end resistance. I think it'll be a lot harder to break through it compared to before. But if we did break this, we would have further resistance at $7, going on to $8. If we break that, I'm looking at around $11.75, $13. And just to go very far out, just in case we did get some sort of a squeeze, we do have levels at $16.50, $18.25, $21.40, and a final level at $23.45. So now, if we did push up to any of these upper levels, again, this is usually where we would consider this a more of a short squeeze. Probably not something I would short with outright shares, because I think there's just a lot of risk on the table unless you're maybe hedging with outright calls. But really, the way I look to play these is usually just playing credit or debit spreads, and then just playing the longer term. If we're hitting, say, that $13 or above, getting maybe 2-3 month out expiration credit or debit spreads. That tends to be how I play these, and in the past it has been quite profitable so far. So that's what I'm looking at on AMC. Again, not something I personally would be touching long bias at all. If it is something you're bag holding, might not be the best time to be cutting out now. Maybe potentially waiting for a push to $5. But either way, definitely something I'd be cutting out really as soon as possible, because in time most likely is going to continue down, considering, like, if you see anything from 27.50 to a low of around 3.50, you're going to see it go lower. Just because the stock's down 90% doesn't mean it can't fall another 90%. Anyway, hope you enjoyed the breakdown. If you did, why not drop a like and subscribe, and check out this analysis video.